are so many people content with a 1.5% dividend yield on a broad index fund or an ETF?
Hey there, dividend delivery for Robbie Bunny.
Your dividend, sir.
But at the end of the day, there are definitely some who just want more.
I want more.
So maybe they go out and they buy an ETF like SCHD over 2 times the dividend yield of the broad stock market.
I want more.
And so maybe after SCHD, you still have that thirst for more dividends. So you go buy a real estate investment trust.
I need more.
And so when the real estate investment trust doesn't satisfy that craving, you decide to go big or go home. So you buy JEPI. But then you realize you need to ask yourself one very important question. Can I trust it? So JEPI has a dividend yield of over 10%, people, over 10%, and it's beaten the S&P 500. The 37% rate of return since inception, compared to the S&P 500 over the same time period being 33%, with dividends reinvested, of course. And you have to say to yourself, if I just told you those two things right there, would you not tell me JEPI's the best ETF that there is? JEPI's the GOAT. It's the greatest of all time. It's the best ETF there is. If I just told you those two things, you might say that. And hey, maybe it is true. I'm going to discuss this ETF in this video, obviously. I'll tell you my opinion on it. But there are some kind of opaque things in JEPI, and that's one of the things we do need to discuss to figure out, is that going to be a problem? Because JEPI has its lovers. There are people who love this ETF, and there are people who do have their concerns about it, rightfully so. So let's start this video with a graphic that I created. So this is how JEPI works. This is how JEPI finds stocks to put into its portfolio and how it constructs the portfolio of companies and the other opaque thing we're going to talk about that goes into this ETF. Now on the left side, we have the S&P 500 index. You probably have heard of it, I'm sure. It is probably the most popular index in the world, and it is the top 500 largest stocks inside the United States. Most of the stocks that go into JEPI have to come from here. So generally speaking, what happens is there are 120 stocks currently inside JEPI. There doesn't have to be 120. That's just how many there are. And that means there's 380 stocks in the S&P 500 that don't make it into JEPI. What makes these 120 stocks inside JEPI so special? What makes JEPI's portfolio managers want to add them in? Well, they go through a 3-step process that combines research, valuation, and stock selection. The fund says it invests significantly in equity securities of companies included in the S&P 500 index. Remember, it says significantly because the next thing it says is the fund may also invest in other equity securities not included in the S&P 500 index. Securities are not selected based on anticipated dividend payments. That is a huge thing for a lot of people because most people see JEPI, it pays a 10% plus dividend yield right now, and you're thinking to yourself, obviously invest in dividend stocks only. And the answer is no, it does not screen for dividends. Not like SCHD, there are stocks that don't pay any dividends in JEPI. And it says the fund seeks a lower volatility level than the S&P 500 index. And so that's another important thing. It's trying to find stocks that are not volatile. So how does an ETF pick non-volatile stocks that are going to beat the S&P 500? We have to kind of wrap our heads around this and understand what JEPI really is. So on the right side, I have the actual portfolio of JEPI. So there are 120 stocks like we saw before, and those 120 stocks are actually 80 to 85% of the entire portfolio of JEPI. But there's another part of JEPI. It's the 15 to 20% of equity-linked notes, or ELNs, which are derivative products, and there are actually 16 ELNs inside JEPI, and it's 15 to 20% of the portfolio. We're going to talk about the ELNs in a second, but we do want to go over some general things about JEPI. So first off, expense ratio of 0.35%. For its category of what it is, it's actually not a very high expense ratio, so comparatively speaking. However, if you compare it to like an SCHD or just like a VOO, it is expensive because it's a lot more of an expense, but it's still not huge. This is not a passive ETF. It's not trying to track just an index. The portfolio managers, they're going out and they're trying to find these different securities and ELNs that go into this portfolio. Okay, let's talk about the stock portfolio. Distribution yield, 11.9%, people. It is a huge distribution yield. This is mammoth for any type of dividend payment. You would always think that that's too much money. So is it too much money, right? Is there an issue here? Is there a dividend trap? We need to figure this out, okay? So if you had $10,000 invested inside of JEPI, that's $1,190 per year that's going to be paid to you. If we take a look at the SEC yield, which is taking into consideration more, let's say, current interest rates, we have an SEC yield of 10.7%. And that means annual income on $10,000 of $1,070. Let's take a look at the SEC yield because it's the lower one. We want to be more conservative in our ideas here. And so we're going to take that part, 10.7%, and let's say we look at those 120 stocks. Okay, what I did was I took all of those companies, I put them in a spreadsheet, and I said, what's the average dividend yield of these companies? It's 2.3%. That's not that much, right? I mean, that's not a very high interest rate. And then when I actually weighted it by size of the holdings, it's actually 1.6% would be the average dividend yield of those 120 stocks inside the portfolio. If you're not getting this yet, well, the stocks are 80 to 85% of the entire portfolio. Yet the stocks only yield 1.6%. The other part is the ELNs, but the ELNs are only 15 to 20% of the entire portfolio. So we have to do some math to figure out what's going on here because it's getting a little weird, right? That sounds weird. Okay, well, 1.6% of the 10.7% yield comes from the stocks. What's that mean? The other amount has to come from the ELNs. Assume 9.1% is coming from ELNs, and you have to ask yourself, how on earth is 9.1% coming from ELNs, and how much risk are we taking? So let's talk about ELNs, and I'm going to admit I am not an ELN expert. I don't know much about these. These are derivatives products. Usually you'll have to go to someone who's an expert with these, really kind of a small part of finance that would understand truly what's going on inside of a derivative product like an ELN. It would be like a product specialist, basically. So remember, this is the 15 to 20% of the portfolio, not the 120 stocks that are in it, but the 16 ELNs that are in this. And again, we're gonna assume 9.1% of the yield coming off of JEPI is coming from the ELNs. These are the ELNs, okay? So there's 16 of them. First one, Barclays Bank PLC ELN 63.40%. It's linked to the S&P 500. So what's this doing? Well, an ELN is an equity linked note. It's a derivative product, and basically it's linked to the S&P 500, and it uses call options or covered call option strategies to try to generate income for this ETF. From what I've read, I believe they're out of the money covered call options. I am not 100% sure on anything that's inside of these ELNs. I don't know the strategy. They don't have to disclose this to us, which is one of the issues with JEPI. It's a bit opaque. So of course, let's talk about the ELN risks. Is there any risk in these, basically in these derivatives products? Will these come back to hurt us somehow? So let's take a look at what it says inside the annual report. In addition, since ELNs are in note form, ELNs are subject to certain debt security risks such as credit or counterparty risk. Let's say those companies go out of business, right? Or there's an issue and they can't deliver on their promises of this derivative contract. Well, that's counterparty risk, right? And so it says, should the prices of the underlying instruments move in an unexpected manner, the fund may not achieve the anticipated benefits of an investment in an ELN and may realize losses which could be significant and could include the fund's entire principal investment. Now, what that reads to me is that these ELNs they're buying, you can essentially lose the entire principal of the ELN. And how I'm reading that is essentially, well, maybe the ELN can go to zero. It's possible. So that's what I'm going to assume in my analysis here is that, well, these ELNs, or at least some of them, can potentially go to zero. So there's also a value total of $2.5 billion inside ELNs inside of JEPI. What's that mean? How does that work in context? The total net assets, all of the money inside JEPI, $17.5 billion. So the underlying assets of JEPI is that much. Okay, well, let's take a look and say, okay, what if an equity linked note or an ELN were to go to zero? What would happen? Okay, so let's take a look at the Barclays Bank ELN. Now, let's say that Barclays, I don't know, it goes out of business, right? Huge bank run, because bank runs are apparently happening these days. And Barclays goes to zero and it can't pay back or honor its obligations on its derivative contracts for whatever reason. Okay, so what would happen? Well, let's say Barclays Bank ELN has $175 million. That's how much money is inside of that. The JEPI net assets is $17.5 billion. Well, we'll divide it and we'll say, actually, this ELN is about 1% of the portfolio of the fund. So the way I understand this is if this Barclays ELN were to default and go away, possible JEPI loses 1%. Now you add up all the ELNs, and we know that it's about 15 to 20% of the portfolio. So if all of the ELNs were to like poof, go away, they basically blow up. In my opinion, the way I read this is JEPI can lose 20%. I'm not a derivative expert again. Possible that I'm wrong and there is a way that these could end up bleeding into the other equity part of the portfolio, but I haven't thought of a way. So I think 20% is what I got for this. So now there's another thing, okay? The ELN, can they have a drag on the portfolio? That's another question. So covered call strategy risk. So when the fund sells call options within an ELN, it receives cash, but limits its opportunity to profit from an increase in the market value of the underlying instrument to exercise price, plus premium received. So let's just say in a situation where the market is very bullish and also not tons of volatility, it's possible that these ELNs don't perform very, very well inside a different type of environment than we're in now, which is when things are going down with volatility, right? Going up without volatility might be different. All right, let's talk about my expectations. Now, I think that JEPI, the stock portfolio of JEPI, is going to underperform the S&P 500 over the long term, right? Okay. This is if you take out the reinvestment of dividends, the reinvestment of the yield in JEPI, this is what you get. I'm comparing it to the red or orange line. Is that red? I think that's red. That's SCHD is red. Green is the SPX or the S&P 500 index, and the black is JEPI. As you can see, if you don't reinvest the yield in JEPI, you've only made 5.8%. Now, to compare that to the S&P 500 index, if you don't invest the yield in the S&P 500 index, you have about a 32.9% gain. Why is this apples to apples? Well, S&P 500 and JEPI have about the same yield on the stock part of the portfolio, right? Around 1.76%, right? So I think that this is a kind of apples to apples comparison. Another way to look at this, we can actually look at the compound annual growth rates of these. So if we say when JEPI is not reinvesting dividends, JEPI is going to be underperforming, at least it has historically. JEPI had a 1.82% compound annual growth rate over since it's been incepted. SPY, or the S&P 500, 10.08% compound annual growth rate, so much better, and not reinvesting dividends, remember, same yield as JEPI. SCHD has a higher yield, 3.5-ish%, and it still had a higher rate of return, not investing the dividends back inside of it, 13.58. I follow up on my expectations here. I think that the yield is going to revert to the mean. This is the yield over the past, well, since let's say July of 2021, this is JEPI's yield. This is the trailing 12 months dividend yield of JEPI. It fluctuates. Look how much it's up since, let's go with since April of 2022. This thing has been on a tear. The yield is going up and up and up, and likely because of those ELNs, the covered call portion of those ELNs has been performing really well, and it's generating lots of income. But if you look back before that July 2022 time period, what do you see? You see yields under 8.5%. And so I think that this is going to be much more normal going forward with JEPI. So I'm penning in 7 to 8% yield maybe on this total. So what do I get from this? Well, I get JEPI underperforming the S&P 500 in my opinion going forward. If you reinvested the dividend, let's say, JEPI returns, in my opinion, maybe 1 to 4% on the stock portfolio, 5 to 8% in the dividend yield. Again, it's going to probably revert to the mean. And that gives us after, okay, we have to talk about taxes here too. So this actually pays around 15% are qualified taxes in JEPI, but the other 85%, they're non-qualified taxes. This is going to fluctuate. It's not going to always be the same. It's maybe 6 to 12%. 12% is being up there for the potential return if you don't have to pay taxes on JEPI. And if you were to factor in taxes with a 25% tax rate, maybe 4.6 to 9.2%, reinvesting the dividends into JEPI could be the potential growth on JEPI. Now, all of this being said, what do I think about this? So first off, I think that you can have JEPI invest in stocks within the stock portion of the portfolio and still get good yield. And that's the one thing that I think a lot of people do want. You want capital appreciation, but you also want yield. In other words, I wouldn't expect taking all of my yield out of JEPI to basically hurt my portfolio too much. I think it could still withstand and grow even if I take all my yield out. Now, the other part of this is that I don't think it's going to grow as much though. So if you really are factoring in, you're trying to get growth out of this, this is probably not the thing that I would want for myself. I would not want this. I'd want something more like SCHD. And so for that reason, because I really care more about growth and having just some dividend components in my portfolio, I would rather have an SCHD than a JEPI. But again, there are different people out there. If you're retired and you need yield, then this could be okay, as long as you're okay with those kind of opaque ELNs, right? And so if those don't scare you, if you're okay with what's going on there and having some derivative contracts inside your ETF portfolio, hey, maybe JEPI's not so bad. That's all I got for this video. Hey, if you haven't watched my video on SCHD, the king of ETFs, take a look at it right here. Disclaimer here. See you next time.